In the heart of the Italian Dolomites, an orphan named Leonardo del Vecchio began a journey that would eventually lead to control of nearly half of the global eyewear market. He started with a small tool and die shop making metal parts or glasses, but he possessed a vision that far exceeded the lenses he manufactured. Today, the entity he forged, EssilorLuxottica, stands as a vertically integrated titan that controls everything from the raw resins in a lens to the high street retail experience. But within this empire lies a shadow number, a figure that defines the true cost of dominance and the strength of their moat. That number is 80%. This is a percentage of all eyewear innovations globally that now pass through their research labs or distribution networks. It is a level of consolidated power rarely seen in any industry, and for the dividend growth investor, it represents a fortress built on the very necessity of human sight. The genesis of this behemoth is a masterclass in aggressive consolidation. For decades, Luxottica and Essilor moved on parallel tracks. Luxottica, under Del Vecchio, conquered the frame market by acquiring iconic brands like Ray-Ban for mere $640 million in 1999, a price that looks like a rounding error today. Simultaneously, the French firm Essilor was perfecting the science of the lens, inventing the Varilux progressive lens, which revolutionized how the world corrected presbyopia. The two were the ultimate symbiotic pair, yet they remained fierce independent competitors until a landmark merger in 2018. That union was not just a business deal. It was a geopolitical event that created a closed-loop system. They no longer just sold a product. They owned the entire value chain. By the time they swallowed Grand Vision in 2021, they had added over 7,000 retail doors to their empire, ensuring that no matter where a consumer turned, they were likely transacting with the group. The operational engine of EssilorLuxottica is fueled by two distinct yet integrated cylinders: professional solutions and direct-to-consumer. In the fiscal year 2025, the group generated a staggering €28,491 million in total revenue. The direct-to-consumer segment, which includes retail giants like Sunglass Hut LensCrafters and the recently integrated Grand Vision, accounted for €14,891 million, or approximately 52% of the total. On the other side, Professional Solutions, which provides lenses, frames, and equipment to independent opticians and third-party retailers, brought in €13,600 million, representing 48% of the mix. This balance is their secret weapon. When retail foot traffic slows, their wholesale lens business provides a high-margin floor. Geographically, the empire is truly global, yet heavily anchored in the West. North America remains a primary engine, generating €12,787 million, or roughly 45% of group sales. Europe follows closely with €10,779 million, accounting for 38%. The Asia-Pacific region, though smaller at €3,410 million, or 12%, represents the frontier growth, while Latin America rounds out the remaining 5% with €1,515 million. When we benchmark these operations against the field, the scale becomes almost terrifying for competitors. While companies like Alcon or the Cooper companies compete in the specialized contact lens and surgical space, they lack the lifestyle and fashion retail footprint of EssilorLuxottica. In the luxury frame market, Safilo remains a distant second, often struggling to maintain the licenses that EssilorLuxottica hoards like crown jewels. While Safilo and other players operate with operating margins often in the mid to high single digits, EssilorLuxottica has consistently pushed into the mid-teens, proving that vertical integration is not just a buzzword, but a margin-expanding reality. To understand the financial durability of this business, we must apply a forensic lens to its long-term compounding. Over the last 25 years, a period marked by the great financial crisis and the global pandemic, the group has navigated structural transformations that make a simple revenue comparison difficult. However, the trajectory is clear. The 5-year revenue compound annual growth rate stands at an impressive 10.5%, reflecting the successful integration of Grand Vision and the post-pandemic rebound. Over 10 years, that rate holds steady at approximately 8.4%. If we look back 25 years, accounting for the separate histories of Essilor and Luxottica prior to 2018, the combined pro forma revenue has grown at a compound rate of roughly 7.2%. This is not a high-flying tech company. It is a steady, relentless encroacher on global market share. The margin profile reveals the true quality of the earnings. The adjusted operating margin for 2025 stood at 15.7%, a slight compression from 16.7% the prior year, primarily due to the headwinds of United States import duties and heavy investment in the next generation of smart glasses. However, the free cash flow engine remains robust. The group generated a record €2.8 billion in free cash flow in 2025, representing a free cash flow margin of nearly 10%. When we look at the compound annual growth rate for free cash flow, the 5-year figure is a remarkable 12%, while the 10-year average sits at 9.5%. This cash generation is the bedrock of their capital allocation strategy, allowing them to carry a net debt of €10.85 billion with ease. Their leverage ratio, measured as net debt to EBITDA, is a conservative 0.91, significantly lower than many of their peers in the medical device and luxury sectors. Their interest coverage ratio remains comfortably in double digits, ensuring that even in a higher interest rate environment, the fortress is under no threat of breach. For the dividend growth investor, the Dividend Fortress is the primary attraction. The group has proposed a dividend of €4 per share for the 2025 fiscal year, a significant jump from the €3.23 paid just 2 years prior. The current dividend yield hovers around 2%, which may seem modest until you examine the growth rates. The 5-year dividend compound annual growth rate is a staggering 25%, a figure skewed by the restoration of payments after the 2020 hiatus. But the 10-year CAGR of 13.5% tells a more consistent story of shareholder commitment. Over 25 years, the dividend has grown at an average annual rate of approximately 9%. This growth is supported by a disciplined payout ratio, which currently sits at roughly 49% of free cash flow, leaving ample room for both reinvestment and further increases. Beyond the cash dividend, the company has utilized buybacks to enhance total shareholder yield. The buyback yield over the last 5 years has averaged 0.4%, while the 10-year average is slightly lower at 0.3%. While they are not as aggressive with share repurchases as some American counterparts, their focus on organic growth and strategic acquisitions, like the recent $1.5 billion purchase of Supreme, demonstrates a preference for expanding the moat over simple financial engineering. This policy is superior to competitors like Safilo, which has struggled with consistency, and even compares favorably to luxury giants like LVMH, which, while offering higher absolute growth, often carries a much lower dividend yield and a higher valuation multiple. However, no fortress is without its risks. The current geopolitical landscape presents a two-front challenge. First, the escalating trade tensions and tariffs, particularly between the United States and China, threaten the global supply chain that the group has so carefully constructed. Second, the rise of low-cost online competition from platforms like Temu and Alibaba is beginning to nibble at the lower end of the market, offering frames and lenses at a fraction of the price. Yet, EssilorLuxottica has faced these threats before. In the early 2000s, the rise of online eyewear disruptors like Warby Parker was supposed to be the end of Luxottica. Instead, the group simply improved its own digital offerings and leveraged its brand power to remain the aspirational choice. Today, they are pivoting toward the next existential threat: technology. Their partnership with Meta to produce Ray-Ban smart glasses is an attempt to ensure that if the world moves away from traditional frames toward augmented reality, they will own the hardware. Looking forward, the guidance of the next 1 to 3 years remains optimistic. The group expects annual organic revenue growth to settle into a range of mid-single digits, supported by the tailwinds of an aging global population and the increasing prevalence of myopia in younger generations. They are targeting adjusted operating profit to be between 19 and 20% of revenue by the end of 2026, a goal that will require significant synergy captures from the Grand Vision integration and the scaling of their MedTech division. When we look at the weekly chart and the current valuation, the case for entry becomes a matter of precision. Based on a current enterprise value to free cash flow multiple, the stock is trading near its historical median, suggesting it is fairly valued but not a screaming bargain. For the patient dividend growth investor, the ideal entry price range lies between 175 and 185 euros. This range aligns with significant technical support on the weekly chart and provides a margin of safety against short-term macroeconomic volatility. At these levels, the forward free cash flow yield of approximately 6% becomes attractive enough to justify a long-term position in a diversified portfolio. In conclusion, EssilorLuxottica is the embodiment of an industrial monopoly hidden in plain sight. They have mastered the art of vertical integration, turning a medical necessity into a high-margin fashion statement. The mystery number we began with, that 80% control of innovation, is the reason they can command the prices they do and why their dividend is among the most secure in the European healthcare and luxury sectors. They are not just selling glasses. They are selling the very way we perceive the world. For those seeking a blend of stability, growth, and a fortress-like yield, this is a cornerstone asset. Thank you for listening to this archive. I am Cash, and this was CASJ Global Dividend Intelligence. Stop guessing. Start knowing.